Hey everyone, it's Smart Cash, and today we're diving deep into the world of investing mistakes, specifically mine. Yeah, you heard that right. Even I, your trusty financial friend, have made my fair share of blunders in the market. Remember that time I went all in on that guaranteed tech stock? Let's just say it didn't age well. The thing about investing is, it's as much about learning from your mistakes as it is about celebrating your wins. In fact, I'd argue that those tough lessons are way more valuable in the long run. Why? Because they teach you to think critically, manage risk, and ultimately, become a better investor. So, buckle up as I walk you through some of my biggest investing fails, the costly lessons I learned, and how you can avoid making the same mistakes I did. Trust me, your portfolio will thank you for it. Alright, let's start with a classic mistake that trips up countless new investors: not diversifying. It's a common pitfall, especially for those who are just starting out and are eager to see quick returns. Early on, I was so laser-focused on finding that one unicorn stock, the one that would skyrocket my portfolio into the stratosphere, that I completely neglected to spread my risk. I was convinced that if I could just find that one golden opportunity, I'd be set for life. I poured way too much money into just a handful of companies, mostly in the tech sector because, well, tech was hot. Everyone was talking about the next big thing in technology, and it seemed like a no-brainer to invest heavily in that area, and for a while it seemed like I was on the right track. Some of those stocks did pretty well. I saw my portfolio grow and I felt like I had made the right choices. It was exhilarating to see those numbers climb. But then, boom, market correction. Out of nowhere, the market took a nosedive and all those gains I'd been so proud of started to evaporate. It was a harsh wake-up call. Suddenly my concentrated portfolio was in free fall. I watched in horror as the value of my investments plummeted. It was a gut-wrenching experience, one that I wouldn't wish on anyone. It was a harsh reminder that diversification isn't just some abstract financial concept. It's fundamental to protecting your hard-earned money. Diversification spreads your risk and helps cushion the blow when the market takes a turn for the worse. Remember, even the experts can't predict the future. No one has a crystal ball that can tell you exactly what's going to happen in the market. That's why it's so important to have a diversified portfolio. That's why it's crucial to diversify across different asset classes. Stocks, bonds, real estate, you name it. Each asset class behaves differently, and by spreading your investments across them, you reduce the risk of losing everything at once. And within those asset classes, spread your investments even further. Don't put all your money into one sector or one type of investment. Diversify within each asset class to further mitigate risk. Don't just buy tech stocks, explore other sectors like healthcare, consumer goods, and energy. Each sector has its own set of risks and opportunities, and by investing in a variety of them, you can create a more balanced and resilient portfolio. Think of it like this: you wouldn't bet your entire life savings on a single hand of poker, would you? Just like in poker, investing requires a strategy that spreads risk and maximizes potential returns. Diversification is your safety net, your way of ensuring that even if one investment goes south, your entire portfolio doesn't go down with it. It's about creating a financial cushion that can absorb shocks and keep you on track towards your long-term goals. Next up, let's talk about the seductive allure of market hype. It's a phenomenon that has captivated investors for decades, and it's not going away anytime soon. We've all been there. You see a stock trending on social media, everyone's talking about it, and the fear of missing out, FOMO, starts to kick in. The buzz is infectious, and it feels like a golden opportunity you just can't miss. You convince yourself that this time it's different, that this stock is the golden ticket to riches. The excitement builds as you imagine the potential gains, and you start to believe that you've found the next big thing. But here's the thing about hype: it's often driven by emotion, not logic. The frenzy can cloud your judgment, making it difficult to see the risks involved. You might overlook critical information or ignore warning signs because you're caught up in the excitement. And when it comes to investing, letting your emotions take the wheel is a recipe for disaster. Emotional decisions can lead to impulsive actions like buying at the peak or selling in a panic, which can result in significant losses. I learned this the hard way during the whole meme stock frenzy. It was a wild ride, with stocks soaring to unimaginable heights based on nothing more than internet hype and viral trends. Remember that? It felt like everyone and their grandma was buying up shares of companies that frankly had no business trading at those levels. The hype was so intense that it seemed like a sure thing, but reality eventually set in. I got caught up in the excitement, ignored all the red flags and ended up buying high and selling low, the cardinal sin of investing. It was a painful lesson, but one that taught me the importance of staying grounded and not getting swept away by the hype. The problem with chasing hype is that you're usually buying into an asset that's already massively overvalued. By the time you jump on the bandwagon, the price has often been inflated far beyond its true worth. And when the hype inevitably fades, as it always does, you're left holding the bag. The value plummets, and you're stuck with an investment that's worth far less than what you paid for it. So, how do you avoid the hype trap? Stick to your investment strategy, do your research, and don't let emotions cloud your judgment. It's crucial to remain disciplined and focused on your long-term goals, rather than getting distracted by short-term noise. Remember, the best investments are usually boring, not the ones making headlines every day. Consistent, steady growth is often more rewarding in the long run than chasing after the latest hot stock. Stay patient, stay informed, and let your investments work for you over time. Chapter 3. No research, get ready to learn a costly lesson. This next mistake goes hand in hand with the previous one, not doing your due diligence. It's a common pitfall that many new investors fall into, thinking they can skip the homework and still come out ahead. Look, I get it. Researching stocks can seem about as exciting as watching paint dry. The financial jargon, the endless numbers, and the complex charts can be overwhelming and tedious. But trust me, it's a whole lot less painful than watching your portfolio shrink because you didn't bother to understand what you were investing in. Imagine the frustration of seeing your hard-earned money disappear because you skipped the research. Early in my investing journey, I was guilty of blindly following stock tips from friends, family, and even those so-called gurus online. I thought I could take shortcuts and rely on others' advice without verifying the information myself. I figured, hey, they must know what they're talking about, right? After all, they seemed confident and knowledgeable, and I wanted to believe that they had my best interests at heart. Wrong. The truth is, no one cares about your money as much as you do. When those tips didn't pan out, I was the one left dealing with the losses, not them. Relying on others' opinions without doing your own research is like playing financial roulette. You might get lucky a few times, but eventually, your luck will run out. And when it does, the consequences can be severe. You might get lucky a few times, but eventually, your luck will run out. The market is unpredictable, and without a solid understanding, you're just gambling with your future. So what does proper research entail? It's not just about glancing at a few headlines or skimming through a company's website. It means digging into a company's financials, their revenue, earnings, debt levels, and understanding their business model. What do they do? Who are their competitors? What sets them apart in the market? What are their future prospects? Are they innovating or are they lagging behind? These are critical questions that can make or break your investment decisions. It also means staying informed about industry trends and macroeconomic factors that could impact your investments. The broader economic environment can have a significant effect on individual stocks and sectors. Knowledge is power, especially in the world of investing. The more you know, the better equipped you'll be to make informed decisions that can lead to long-term success. So take the time to do your research. Your future self will thank you. Chapter 4. Emotional investing. A surefire way to lose money. Let's be real. Investing can be an emotional roller coaster. One minute, the market's soaring and you feel like a genius. The next, it's tanking, and you're convinced the world is ending. The key is to not let those emotions dictate your investment decisions. I used to be the king of emotional investing. If a stock I owned dropped a few percentage points, I'd panic sell, convinced it was headed to zero. And when a stock was going up, I'd buy more and more, driven by pure greed. Needless to say, this strategy didn't exactly work out in my favor. Emotional investing often leads to impulsive decisions that aren't based on logic or sound analysis. You end up buying high out of fear of missing out and selling low out of panic. The best investors are the ones who can keep a cool head, even when the market is going crazy. They stick to their investment plan, ignore the noise, and make rational decisions based on their long-term goals. Chapter 5. The long game, why patience is key. This final mistake is a big one, especially for those new to the investing game, ignoring long-term goals and getting sidetracked by short-term gains. When I first started investing, I was obsessed with trying to time the market, jumping in and out of positions, hoping to make a quick buck. I'd get excited about a small gain and immediately cash out, only to watch that stock continue to climb without me. Or, I'd hold on to a losing investment for too long, hoping it would magically rebound, only to watch it sink further into the red. The problem with this short-term mindset is that it prevents you from achieving your long-term financial goals. Investing is a marathon, not a sprint. It's about slow and steady growth over time, not trying to get rich quick. The most successful investors are the ones who can look past the day-to-day fluctuations of the market and focus on the bigger picture. They have a plan, they stick to it, and they let their investments compound over time. Remember, time is your greatest asset when it comes to investing. Learn from my mistakes, grow your wealth. So, there you have it. 5 of my biggest investing mistakes and the valuable lessons I learned along the way. From not diversifying to chasing hype, these blunders taught me the importance of discipline, patience, and, above all, doing your homework. The key takeaway here is that investing isn't about being perfect. It's about learning from your mistakes, adapting your strategy, and constantly striving to improve. Don't be afraid to make mistakes, but be sure to learn from them. Remember, the stock market is a powerful tool for building wealth, but it requires knowledge, patience, and a healthy dose of skepticism. Now go out there, make smart decisions, and watch your portfolio grow.